and welcome to Business Television India. I'm Fatima Mahdi and you're watching Financial Planner. On the show with me right now is Arjun Guha Thakurta. He's the Executive Director at Anand, Rathi Private Wealth Management. Arjun, very warm welcome to the show. We are so looking forward to this conversation with you today. Given where we are at the moment when it comes to portfolios, can you explain to me how you are defining structured products?
Thanks, Fatima. Structured products basically act as a plan B in the portfolio in case plan A doesn't work. So they are very similar to debentures or bonds issued by corporates, which are used to generate returns. The only difference being, unlike the debenture which has a fixed coupon, the returns from structured products are linked to the underlying index, which is Nifty in our case. Let me share an example. In case the markets or Nifty gives a 5% annualized return, the structured products are able to deliver 16 to 17% returns for our clients on an annualized basis. However, there is a disadvantage, which means that the maximum that you can earn from the structures is 16 to 17% per annum. And we use these structured products to deliver consistent returns for our clients over periods where the market movements are subdued or range bound, which is an extremely normal case to expect in shorter periods of time from the Nifty.
Sure. Okay. Arjun, thanks for that explanation. You talk about how you basically use them, predominantly for generating those returns when the market movements are subdued or range bound. And that, of course, has become something that we've looked at. Can you sort of give us any recent examples of when you really thought was the best time to be in structured products, and also how do these respond to volatility in general?
So what happens is, in case of a structured product, like last 10 years, in spite of the markets having moved up, we think that the annualized returns of the Nifty is barely 5.5 to 6. So the traditional liquid investments, which is either the mutual funds or even PMSs, have not really worked. That's where structured products play a very important role in eking out returns for the client.
Okay, so given what you're telling us about structured products, Arjun, can you tell us a little bit about the kind of risks that one associates with such products?
Yep, absolutely. There are two kinds of risks that you associate yourself when you invest in a structured product. The first one is the market risk. But since it used to be used as a plan B on the portfolio, the market dependence should be kept extremely minimal. The second risk that you're taking, and the other advantage of a structured product, is once a client invests the money, the returns are already predefined to the index and it removes any human intervention that can arise. Second, the other risk that we're talking about is the credit risk. Essentially, when you're buying a structured product, you're buying a debenture of an NBFC. Hence, you're taking an underlying credit risk of the NBFC. Now, since 90% of our clients invest in structured products, we use our internal NBFC as a platform to issue these structures, thereby drastically reducing the credit risk that can arise.
Okay, Arjun, a little bit about, since we're talking about NBFCs and structured products, of course, tell me how the whole interest rate scenario works out in this case. I mean, given the fact that we've, of course, just seen credit policy, just give me a sense as to how structured product would perhaps function best right now.
So what happens in this case is, when the rating comes for a structured products have two components. There's a debt component and a derivative component. When the rating agencies look at the rating, they only unfortunately look at the debt portion of the NBFC and they completely ignore the derivatives portion. So according to us, rating is not the only important thing when it comes to looking at structured products. There are other factors which we look at in details as well when we're investing in structured products for our clients.
Sure. Okay, can you tell me a little bit more, or perhaps flesh out how the safety of capital works when it comes to a structured product? Say an NBFC goes bottom up or belly up. How would that sort of work? How is money sort of kept safe when it comes to these kind of tailor-made products?
So the debentures issued in case of structured products are secured with a trustee who is supposed to act in behalf of the interests of the client. What this actually means, or this implies, is the first and exclusive charge of these assets lies with the trustee, who will act in the interest of the client, and in case there's a default in the NBFC, the trustee will ensure that the clients will be the first people to get his or her money back. Also, what we try and do is, over 50% of our balance sheet of the NBFC is invested in liquid funds, GSECs, FDs and mutual funds, which can be liquidated in T plus 3 days on the maximum. That's the way we manage it.
Okay, are there any sort of examples that you can give me in terms of how a structured product has sort of kicked in? I mean, I know Anand Rathi Private Wealth Management has really specialized in coming up with some very interesting and innovative products. But can you tell me a little bit more, sort of give me a couple of examples in terms of how things have, a scenario and how a structured product has sort of really kicked in and sort of saved the day recently?
So what we've been able to generate over the last 1 year, which hasn't been the best year for the markets in general. So all our clients, typically who's been invested with us as per strategy, the average IRR for financial year 19-20 or 18-19, sorry, is in the range of 11.4, which I think the major benefit came from investing in the structured products for the last financial year. So they are all averaging a return of around 11 to 12%.
Okay, and in terms of tailoring structured products according to HNI and ultra high net worth needs, how does that actually work? What is the entire process all about at the firm?
So what happens again is we use this primarily as a plan B. So we don't keep on innovating the structured products. We do the same issuances which we've been doing for the last 5-6 years, if not more. And what seems to be working is the customization, that we just keep it the same stuff that we do, not the customization. We keep it the same, exactly the same structures are issued month on month, which requires the markets to have very, very minimal movement over a 3-year period for our clients to eke out the returns, and they're consistent.
All right. Arjun, a little bit in terms of ratings. I know ratings agencies have really not been looking very good. Credibility, of course, is something that has also been lost given the kind of recent developments we've seen on the back even of an ILFS. But tell me something, how credible are ratings and what are their limitations? And when investors actually take a look at them, especially in relation to structured products, how should we be looking at this whole issue of ratings? What is lacking and what should investors therefore be really mindful of?
So ratings, according to me, is only one of the indicators when you're investing in a fixed income instrument. It is not the only thing that clients should look at when they're investing. Let me give an example of how the rating works. In a structured product, rating, there are two components. One is the debt component and one is the derivative component. So when the rating agencies come, they only look at the debt component to arrive at a rating. They completely ignore the derivative part of it. So ratings, as I said, is not the only thing that one should look at when you're investing in a fixed income instrument. There are other instruments which are available, which you should look at along with rating to understand how good or bad the NBFC is.
All right, sir. Arjun Guha Thakurta, Executive Director at Anand Rathi Private Wealth Management, speaking to us right here on Business Television India. Thank you for that conversation.